Alright, in the meantime, this is a question by Karma, which I find it very good question. If a company's ROE falls below 15%, do we still hold the shares? This is very good. Well, this is actually a very tough question to ask. Okay, so the answer is actually it depends. First of all, we want to avoid buying companies where the ROE drop below 15%. So first of all, we should try to our best to avoid this case from happening. In that sense, to avoid this kind of cases from happening, you want to buy company where have a good track record, probably 5 years or 10 years, where the ROE is above 15%, so that from into the future you can reasonably expect that ROE will be 15% and above. But even then again, if you buy a company where the past 5 years is good, the next few years might not be so good also. You take a look as example, you take a look at Widogen. Even here like 18% ROE, and then suddenly you say, okay, not bad, and then you jump in and decided to buy, it might drop below 15% also. So when it drop below 15%, then how? So first of all, you should try to avoid this happening. So if you cannot, then the next one is you want to see whether whether okay, maybe before that you want to see the company's cash, net cash position. You want to see whether the company's net cash position, whether the company's net cash has increased or not. So if the company's net cash has increased, which means that the company's book value have increased, or the equity have increased, which pulls down the ROE because the book value have increased. So when the company's net cash has increased, and it's because of net cash, so the ROE dropped because of net cash. So I think it's still okay lah. You can still accept this position. To me, I can still accept it. Increase or not. Now, if the company's net cash reduce also, and the ROE also have dropped, then the next thing you want to know is whether the company's profit drop. Sorry. When the company's drop in company's profit, is it temporary or cyclical or permanent? Now, let me give some example of temporary. Now, if temporary, probably it might be due to economy where it's not so good, or recently a lot of companies cut their expenses and so forth. So probably it's cyclical or the temporary one. So in that sense, it's okay. Now, permanent one is where the company have new entry of competitors. Yes, competitor. Take example like Padini, where Uniqlo and H&M come in, and the company's ROE drop. I believe that drop in Padini is permanent because Uniqlo and H&M come in. They take the market share. So generally, no matter how good, because the other two companies, the two competitors are taking the market share, the company's revenue drop, so the ROE will also drop. So that I believe is a permanent drop. That Buffett says, I believe Buffett says, he says one quote. He says, competition is bad for capitalism. So if I forget right here, competition is bad for capitalism. Which means that when there's competitors in the market, it's good for the consumer. Yes, it's good for the consumer. But if you're the owner of that business, that's not good. You want to be in a business where there's less competitors. So competition is bad for capitalism. I believe politics also same. When there are more political party, it's not good for them. Less from political party is better. So less competition. Okay, so you want to check whether the drop in company's profit, is it temporary or permanent? Now, if it's temporary, then it's okay. If it's permanent, then it's not so okay. Then after that, the next thing, after that you need to do valuation on your existing holding, or existing company. to see whether is it still undervalued. So you want to do a valuation again on your company to see and with a new assumption. Like example, earlier you say you buy Padini, and then you thought that the ROE is 30%, and then after that over time the company's ROE keep on dropping, and you see that Uniqlo and H&M are very strong competitor. You go and see the supermarket, you see even your family members and sisters, brothers, and so forth. They also like to shop in Uniqlo and H&M. And the money also has been spent. Previously, Padini one goes there, and you will reevaluate and see that it's a permanent drop. So if it's a permanent drop, then you will reevaluate your company's valuation again based on the new valuation. And if it's overvalued, if based on the new formula and it is overvalued, then you might consider to sell off. Even if it's at a loss, then just move on. You cannot expect to get to make money at all times. But if you make money 5 or 10 times, you make 4 or 8 or 9 times, I think you more than enough to cover your losses. Especially even if you do make any losses, if you have factor in margin of safety, I believe your losses, if have, will be very minimal compared to your gain. Sometimes people might ask me, do I have any companies that I made losses before? Yes, I do. Sometimes it's because of my evaluation is wrong, or sometimes because the company's future is become worse off that which I might expect it to be, but then didn't expect to be that bad. So on and off you find this kind of things. But overall, as long as your long-term results is good, you have more gains and losses, and your losses is kept to minimal, which means and your gains are on the upside a lot, then I think it's okay. So I think margin of safety is very important. So before you buy, if you have a loss of margin of safety, I think that's you won't, even you make losses, you won't be that much. Okay, so if it's overvalued, then you can sell. But of course, the best is if you have better opportunities. Because if you sell, then you take this money and you go and keep in cash. I think that's also generally I don't like. I don't like keeping cash because cash over time depreciates. So in that sense, if I sell that, I want to find another alternative. Put in another company. So the best is if you can find an alternative to put into another undervalued company. So you just imagine that psychologically, you just imagine that you're moving from one company to another, like you're not selling yet. No? This is just psychological basis. Because there are some people I noticed that the company that they make losses or the share price drops and the underlying intrinsic value have really very bad, or upfront they buy a lousy company, they still hold on. They still hold on in the hope that the company suddenly rebound back. I think that itself is a mistake. I mean, your first mistake is buying a bad company. But sometimes you buy a good company, then it becomes bad. It's different. But upfront, if you are speculating and you buy a bad company upfront, that itself is a mistake already. And then if you continue holding on, even when you realize that is a bad company, I think that's the second mistake. Because you cannot move your money to another better company at a better price. So I think that's a mistake. Kind of like in a relationship also. If you go in a relationship with a boyfriend, girlfriend that is not so good, considered bad, that is a first mistake already. It's okay, but it's okay because you learn from it. Then the second mistake that you do is to maintain in that relationship, even you know that it's a bad relationship. Like example, if your boyfriend and girlfriend is if your boyfriend is hitting on you and beating you, just move on, divorce, or just leave. I mean, and life is so short. What time must you endure such a pain? I don't know. That's me. So to me, it's very logical. Just move on. Okay. So the best is alternative. If you have another undervalued company, then you move on. Yeah. So this is all the answers. Yeah. Okay. So Casey, you have anything you want to add on?
No, we're good. Everything's good.
Okay. So in that sense, let's tackle another question. This is a question by Javen, which I forgot to answer in the previous webinar. So I think it's good I answer here.